Everyone thinks the Great Depression started in America. It didn't, it was finished in Vienna. The stock market crash of October 1929 hit New York hard, but Europe thought it was insulated. Banks across the continent had weathered financial storms before. They had gold reserves, international connections, and centuries of trust behind their names. Surely, they reasoned, American problems would stay American. That confidence lasted until May 1931, when the Creditanstalt, Austria's largest bank, collapsed in a single week. What happened in Vienna didn't stay in Vienna. Here's the story everyone tells. The Creditanstalt failed because it was poorly managed and held bad loans. True, but incomplete. The bank had indeed made aggressive bets on Austrian industry during the 1920s boom. When industrial demand collapsed, those loans turned toxic. Depositors caught wind of the trouble. Fear spread. Runs began. Within days, the bank hemorrhaged cash it didn't have. By May 14th, the Austrian government was forced to bail it out, a public admission that even Austria's pillar institution was crumbling. But that's where the real story begins, not ends. The Creditanstalt wasn't just another bank, it was the financial linchpin holding Central Europe together. Austrian companies owed it money, German banks had lent to it, British and French investors held its bonds. When news broke that Austria's biggest bank needed a government rescue, confidence evaporated across borders. If Austria's safest institution could fail, what about German banks? What about Hungarian ones? The panic didn't stay local. Within weeks, German banks faced their own run. Depositors withdrew billions of marks. By July, Germany's largest banks were on the brink. Then Hungary, then Poland. What economists now call the contagion effect wasn't a theory, it was a chain reaction, each domino pushing the next. The Creditanstalt collapse was the spark that turned a localized Austrian problem into a continental catastrophe. Here's what made it worse: governments had no playbook. Central banks didn't coordinate. Instead, each nation raised interest rates and tightened credit measures that deepened the crisis. Austria couldn't print its way out, it was tied to the gold standard. Germany couldn't devalue, its economy was already strangled by war reparations. The interconnectedness that had seemed like strength became a liability. By 1933, the European banking system had effectively collapsed. Millions lost their savings, unemployment soared, factories closed, and in the political vacuum created by economic desperation, extremism took root. The Creditanstalt failure wasn't just a financial event, it was a hinge moment in history. A single bank's insolvency rewired the politics of an entire continent. So why did it cost what it did? Because the Creditanstalt's failure exposed a truth everyone had ignored. Modern economies are webs, not silos. A crack in Vienna became a fracture in Berlin, Budapest, and beyond. Trust once lost in one place spreads like frost. That's the real price of 1931, not just the money vanished from accounts, but the lesson that would take decades to fully sink in. Financial systems need coordination, transparency, and circuit breakers. One bank's collapse taught the world that lesson in the hardest way possible. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to uncover how the financial crises of yesterday shaped the safeguards and vulnerabilities of today. This video is for educational and informational purposes only and is not financial advice. Always do your own research.